Hello there! Ready to embark on a 3-part adventure into QE in the United States? Of course you are. Let's go. Remember, this series is supposed to be a brief guide, not an in-depth college class. Quantitative easing is an economic policy, so we have to talk about the economy first. For our purposes, we're talking about a very small section, a section called YBO. YBO, you, bank, and other stuff. By you, I mean you, the everyday consumer. By banks, I mean private banks, like those you store your money in. By other stuff, I mean very safe investments, like treasuries. All three of these things contribute to the economy in a specific way. You do so by spending, like a good consumer does. Sometimes you want something that you don't have the money lying around to afford, like a car or a house, in which case you will most likely get a loan from none other than a bank. Now, banks love money and are always trying to make more. One of the ways they do this is by lending the money you store to someone else, and then after a certain amount of time, the borrower returns the money plus a little percentage extra called interest. Now, lots of people want loans, but some of them are bad apples. They won't pay the money back for one reason or another, so banks, to avoid such problems, do something called risk assessment via methods like the FICO score. If your risk is too high, you don't get a loan. Typically, in a growing economy, getting a loan is fairly easy. But in a slow economy, banks get very scared of everyday borrowers, as unemployment and business failure increases the risk associated with them. They begin to look elsewhere to invest. One of the places is in safer investments like treasuries. Treasuries are bonds. Bonds have three components: the face value, the maturity length, and the interest rate. Example time. We have Party A, who will issue the bonds, and we have Party B, who has the money to buy the bonds. Party A wants some money right now, and Party B wants more money in the long term. So B buys bonds from A at face value. Then, after the maturity length, A pays B back at face value, plus extra specified by the interest rates. Though bonds like treasuries are almost 100% reliable, the interest rates are not very high and the return on investment thus is low, so people don't typically buy treasuries. But in a slow economy, the risk associated with you blows up. Banks love the low but reliable interest rates rather than those of the high-risk investments like you.